The stock market has fallen into correction territory and is not just within emerging markets or a small percentage of stocks. It's pervasive. Everywhere you turn, it's bad or worse. It's not geographically concentrated either. It seems as though what central banks have done has permanently linked and correlated all assets together. The next crisis will be a shock, even to the most bearish of investors. You came here for the truth, so let me unveil that for you. Today we are going to look at real estate. It's falling from the United States to the UK to Australia. I'm going to show you all the details of that, and you're not going to get this on the mainstream media news networks. They don't want to present you information that is correlated, because then you're going to start to figure it all out. What they do is they give you it piecemeal. They give you one individual set of information and you take it and you read it. Most people read the titles and they don't really get the bigger picture. That's why if you try to have a real conversation with somebody, they stare at you like a deer in headlights. It's quite embarrassing, unfortunately, but if you're watching this channel, I know that you are educated on this topic and you want to know the truth. Well, that's what we're going to do today. I have a lot of information, not a lot of time to cover it, so let's begin by taking a look at what is relevant today, and that is Amazon. So Amazon's opening up these two new headquarters, and already the real estate around those areas started to see a surge. One local brokerage firm reported it sold nearly 150 units over 4 days last week, about 15 times its usual volume. They get into more details, but all I wanted to say is that there's a frenzy that's going on right now, and you can see what occurs when people are desperate to find an asset to put their money into, or simply take a risk and try to see if they can multiply their money. If you were worried about the passive income, if you were worried about a paycheck, you wouldn't go to these areas. You wouldn't want to flood your money into these areas. You would want something that is safe and sound, that has something already established there, and you could make some money off of it on a monthly basis. But if you're chasing appreciation, or maybe you want to flip these houses, this could be what's occurring. You have some investor, they come in, they buy a unit today, and they're hoping that in 2-3 years time they'll be able to flip that unit. But what happens if central banks decide that they're not going to print as much money anymore? Well, guess what? They're already doing so. If you look at what has happened over 2018, you have seen a complete and direct correlation between the central bank's assets, their balance sheets, and asset prices. I have been talking about this, and I have been basically yelling here. Nobody seems to be listening in the mainstream, or they're simply ignoring, and I've been ridiculed over and over and over again. That doesn't matter. I'm going to mention it on every single video if I have to ensure that the public is aware. You know that there is a problem when the correlation appears not just in one asset class, not just in one place around the world, but basically everywhere. And that is happening today. This happens to be a frenzy. We're always going to have that. We're going to see that in future areas, future assets, and it will occur time and time again. Is your cash safe and sound? Looking at this, existing home sales have declined, and look at where the peak is. Basically at the end of 2017, along with all other assets, we saw a peak around that time frame when the central banks decided that it was time to pull back on their asset purchases and begin the quantitative tightening policy. They have already pulled back $1 trillion worth of their garbage quantitative easing, and it's coming to a level now that is starting to actually make a difference on a per month basis. Whether or not they'll keep up with that policy, we'll see, but as of today, it's starting to be more significant when you look at it on a global level. There's still trillions upon trillions upon trillions sloshing around out there, and that has allowed this to get to where it is today. But if you're going to pull back, of course, that's going to have an impact. It's going to have an impact on real estate. It's going to have an impact on stocks and so on. These levels here have been declining to where we've had back in 2014. It is going to these because of all of those easy monetary policies being pushed downward on those housing prices. U.S. home sales, new single-family houses sold in the U.S., so whether we're looking at existing or new, it doesn't matter because they're declining and happens to completely correlate with the Fed and what they're doing with their quantitative easing policy. Free vacations, $100,000 discounts. Home builders get desperate. This right here is out of Bloomberg, and they're talking about this particular individual, a real estate broker, and his particular situation right now. The home buyers he represents are cashing in. They are winning price cuts of more than $100,000 on top of free upgrades such as media rooms, cabinets, and blinds. This generosity flows from increasingly desperate home builders. Hot markets are cooling fast as interest rates rise, and that really is the key indicator. If you want to know what's going to happen, follow interest rates. That is the number one indicator. And of course, there are hundreds and hundreds I think are important, but that one there, that's probably number one. It's the central bank ideas, the central bank capabilities of interest rates and money printing. In the great housing slowdown of 2018, shoppers are reclaiming the upper hand after years of soaring prices that placed the most inventory out of reach for many families. Everybody is hungry for the buyers. And that's when you know that they have become truly desperate. And this is only going to further impact what you'll see with the prices, not just in one or two cities, but of course, all around the world. And speaking of other places, we can see this in Australia has become a huge bubble. Chart of the day. Despite the house price downturn, it's still raining cranes. Australia's population topping 25 million this year. Major cities are not just spreading out, they're stepping up. The crane index has increased, and that's always the worst indicator. When these start to hit their peak, that is when the prices generally fall. And it's odd the way it works. There's the skyscraper index, which you can see for yourself also, that when there are the biggest of skyscrapers being built, that is generally at the peak of any bubble. This talks about the details. If you want to read into it, I'll just show you the chart looking at the National Crane Index. The blue line at the very top is Sydney, and you can see how it peaked out along with most other assets right at the end of 2017, beginning of 2018, along with the other cities here, which some of them have increased. You could see those if you want, but ultimately over the last few years, there has been a multiplication of the amount of cranes. So I bet if I asked people in 2013, are there a lot of cranes in your city? They would say yes, they're everywhere. Now today, it's gotten just into astronomical territory. It's absurd. And it's not just here, it's also happening, I can tell you right now, in Toronto. There are cranes everywhere, and you would think that that's a good thing. Of course, that's a good thing. However, is this justified? How many of these units will sit empty, particularly in the commercial and retail spaces that are being built up every corner? Now let's turn to the UK. UK housing woes deepen with first asking price drop since 2011. And that leads me to this point. Only 13% of Americans say that they plan to buy a home within the next 12 months, making the third straight quarter in which fewer people expect to become homeowners. Why? If the economy is doing so well, and if you're telling me that people are at the absolute highest level of their consumer confidence, then why in the world would they not be buying more homes than ever before? Home ownership is going to have to decrease, and we will see more dormitory style buildings. We're going to see more rentals. We're going to see more of this tiny home revolution, if anything, because a lot of people are going that way. They're going into their RVs. They're going to live in their cars. They're seeing constant tent cities being built, and it is a matter of fact that this is only getting worse. It's not just in the US, but it is pronounced when we tend to get those statistics. We see huge swings back and forth because there's always this mainstream media bias to push this BS on you, and people get fooled by it. People are always getting fooled by it and suckered in. This is just one situation that I really fear for the United States yet again, as we could definitely see another crisis occurring right now in the coming years. The ranks of the would-be home buyers are thinning. Share of Americans who say that they plan to buy in the next 12 months. You'll see that this has been declining over the last little while. It doesn't surprise me because of the price that they have to pay for a home, as well as interest rates rising, making it very, very difficult to do so. Major cities where the housing prices are plummeting. Look around, you'll see that for yourself. Santa Rosa, for example, in California, whether you even look to a place like Toledo, Idaho, are declining as well. So these are the details from Go Banking Rates. If you want to see them for yourself, definitely do so. I won't get into any more of those details, but just to cover a quick few points: borrowers flee empty malls and bond investors brace for fallout. Things are getting worse for the malls across America. Owners are walking away early from struggling properties, a trend that has mortgage bond investors bracing for losses. They get into more of these defaults right now. If you are owning a mall, if you are in retail, now is the best time to jump ship. That's my opinion, nothing more. Nationwide, just 38% of jobs pay enough to afford a middle or upper class life for a dual income earning family with children. 38% of jobs. That's it. That number should be close to 100%. You're telling me there's full employment. You're telling me that. At the same time, you're putting all of the garbage on me, telling me that the economy is doing wonderfully, telling me that everything is just fine, and yet 38% of jobs pay enough to afford a middle-class lifestyle. Nothing but BS and nothing but garbage. Well, I hope you got something out of this video. You can't look at the mainstream media for what it is. You need to connect the dots together. And I try to do that here on the show, definitely. I hope you appreciate it. If you do, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. I'm seeing more thumbs up today, and I'm really grateful to you that you have been doing so. Thank you all. If you want the financial education you were not taught in school, these two books have it all. I get into everything from the foundation to the asset classes, how to make money, how to profit, self-sufficiency, and so much more. Check it out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.